and welcome back to another episode of our Dolfin Discussions. I am James Gutman, and I am the head of investment portfolios here at Dolfin. And I have with me today, once again, my very dear friend and longtime colleague, Andrew Dodson. He is CIO and managing partner of Philipp Advisors and has spent quite a few years in the oil industry. He was a partner at Millennium. He ran a desk at BTG Pactual, and he was at Arcadia, amongst other positions. So Andrew's got a lot of experience in the crude oil space. We spoke with Andrew a few weeks ago in the aftermath of some of these really quite dramatic moves in WTI as the May contract was approaching expiry, and we saw prices plummet to minus $37 a barrel, which required quite a bit of explanation to try and wrap your head around. And Andrew was very, very informative at that time as to how he saw the market trading and what got us there and where we might go following. What I'd like to do today, though, is rope Andrew back in and pick his brain a little bit about the physical market, because I don't think we really had a chance to spend that much time on that aspect of the crude oil space. So Andrew, again, welcome back. And I'm just going to dive right into it. So can you tell me, how do you think the physical market in crude oil has been responding to these really dramatic price swings that we've seen recently in the paper market?
Yeah, I mean, it's obviously been an exceptional time in the oil space. And ignoring, I mean, I bumped into one of the global heads of one of the banks and their trading desk the other day, and he said they'd had to figure out how to capture negative prices in their pricing system. You know, there are some very rudimentary things that have impacted a microcosm of the world. But the physical oil market is ultimately where the prices can, you know, the derivatives prices ultimately converge on reality, which is the physical world. And the physical world is in an awful lot of distress at the moment, it's safe to say. The reason the prices in the US got particularly cheap is because, as we discussed, the landlocked nature. But that's not to say that globally we aren't experiencing very low prices across the whole of the globe. You know, the US is particularly badly affected, but the North Sea market has traded down to, you know, near record lows. You've had the Middle Eastern benchmarks traded down to near record lows. You have a huge amount of unsold, or not unsold crude. There's always a buyer for something at a price, as we saw, you know, in the US when it went to a negative price, someone was paid to take it away. You know, there's always someone going to take it. But the end demand is simply not there at the moment. Conservatively, you know, we have between 20 and 30 million barrels of demand that's not there, that's now not been there for, you know, I think about 90% of the world's economies are now in some level of COVID lockdown. That's affecting air traffic, that's affecting road traffic, that's affecting all aspects of life. People aren't commuting to work. So demand as a whole is really been hit. Now, obviously, you'll read about the odd crack of sunshine in the physical market. Obviously, plastics, one of the major feedstocks for plastics, naphtha, or petroleum products, and parts of the crude oil barrel are used in as petrochemical feedstocks, and so in the making of disinfectants and in the making of PPE equipment for hospital workers. And
yeah, but
Andrew,
you and I both know it's mostly transportation.
But the majority of demand has, and always, you know, we can make as many masks as we want for healthcare workers and all the population, but there's a lot less plastic in oil in a face mask than there is in a petrol tank when you drive to work. So let's not kid ourselves. These micro demand events are not carrying the whole market. So the whole physical market is in significant distress. There are, you know, major issues with the physical market. We have as we discussed with the landlocked nature of TI in the last discussion, there was a finite amount of resource to store it. in the wider world, okay, it's not landlocked, but there are only so many storage facilities on land for oil in the rest of the world, and there are only so many ships that are available in the rest of the world for storage. And more importantly, the more ships you take into the storage pool, you take out of the daily the freight pool. So just getting things from A to B becomes more difficult. So you can create within the global framework, there could be a situation where in a particular geography you may have real containment issues with the seaborne crude, with waterborne crude. So we're experiencing unprecedented issues. We have some sort of banking issues as well. We've had a couple of major bankruptcies within the trading fraternity in Southeast Asia in particular. A firm called Hin Leong has gone to the wall. Now, that's not necessarily to do with the price, but maybe to do with some other aspects. But the ability to finance oil on the water has got more difficult for people. So there is a limited amount of financing available for people to buy the crude and to store it. So we're seeing, the access to capital, which has never been an issue, is becoming an issue as well, because people are worried about the absolute prices of oil. So the physical market is under strain in a number of ways, and it feels like we've had a brief reprieve in the derivatives market, in the sense that some of the US data last week showed that the supply-demand imbalance wasn't as great as people had anticipated, so the builds were smaller.
Pretty large.
They were still significant, and when you're looking at global inventories growing something like 50 million barrels over the course of a week, you run out of storage, and that's the easily reported storage as well.
So let's drill into that. So I was playing around with the EIA numbers on global crude and product supply and demand, just very, very high level, and it looks like they have the market in a deficit until August. I'm sorry, in a surplus until August. And if you just kind of add things up, it looks like there's about 2 billion barrels in play. It's about 2 billion barrels. A cumulative 2 billion barrels that just gets wiped out from demand until you get back into a deficit market. So obviously, that 2 billion barrels relative to where you were on January 1st, so demand has taken out another 2 billion barrels. Supply either comes down and meets it, or that supply, which would have gone and filled that 2 billion barrels of demand, goes into inventory. Now, when we started the year, we had somewhere between 1 and 1.2 billion barrels of available storage remaining globally in any shape and form. I'm talking about Chinese SPR, tankers, rolling stock, anything. Swimming pools. I'm joking, but like everything. So it looks to me like, just to keep the world from having toxic waste spilling over the top of tanks, which is clearly not possible, you have to take something like 1 billion barrels of supply offline over the course of 6 months.
Yeah, cumulative billion barrels.
Cumulative billion barrels, which is pretty meaningful. I mean, this is a semi-permanent. This is a long-term closure of supply that takes a while to come back. Now, let's say demand recovers as per the EIA, sort of latter part of this year, even modestly. That supply isn't going to switch back on immediately.
No, I mean, I think that the issue you have with the demand, the demand side is that, you have airlines talking, Lufthansa came out last week and said it will take maybe 7 years for us to see, if at all, air travel return to pre-COVID crisis levels. So there's a lot of assumptions in any demand recovery. So ignoring how anyone models forward demand, and even if we were to assume that demand came relatively close to where it had been before, which I think is impossible.
Agreed.
The supply side has to curtail so much supply, and there will be a lot of economic supply reductions fairly promptly. You're seeing it in the US. There's probably 4 million barrels a day of shale oil production that's been added since 2016, much of which is, some is just going to get switched off. You're already seeing that in the unemployment figures coming out in the US, in the non-farm payroll figures. You're seeing significant unemployment in oil field services.
Oklahoma and North Dakota. Yeah, absolutely.
So, you can see that that's fairly obvious, and that will be seen in a commensurate reduction in supply. You obviously have this sort of, and we can come to it as a separate subject in a bit, some supply cuts from the OPEC plus group, which is sort of died, which we can deal with in a separate thing. So there are going to be some national oil companies that cut supply. And you've even seen the Norwegians cutting supply, which is fairly unheard of.
The thing is, so you have all these supply. So I think I think you're onto something, because you have all these guys who are cutting supply. Inventory is effectively topped out. We have to cut supply today in order to meet starvation demand today. Then let's suppose demand recovers even modestly. We go from 0 flights at Heathrow to 3 flights at Heathrow, kind of thing. A very, very modest recovery. Yeah. That supply is already shut down.
Yeah, but the issue
back on.
No, and the supply won't. The difficulty for the supply side switching back on is the amount of borrowed demand that we have in storage as well, means that even switching back on that, you have this implied supply that's sitting on ships and things like that. So the taking an oil field down, certain oil fields, if you take them down, it's impossible to generalize, because all things are different.
It all varies, but
the longer you leave something switched off generally in oil, the more difficult it is to switch back on. So there are certain technologies like shale oil, which are very easy to reinstate. There are certain, like Saudi oil fields, that if you take them down, you may never get them back. And there's every color of the spectrum, everything in between. Now, bringing back that supply is going to be very difficult. So what one would presume, if the demand does recover, we'll lose a lot of economic. We'll lose all the sub-economic stuff. It'll be driven by simple numbers, what gets switched off first. But once the economics turn around and improve, what comes back will be more difficult and slightly less transparent, because it's going to be a function of how long it takes to get back to recovery, what the pace of demand recovery is. Equally, at the moment, we're storing what's the mixture of oil in that's in inventory, because that's going to impact which fields stay running during the course of this sort of demand recession on oil, and will materially impact the economics of bringing back particular types of oil and particular types of oil field. So ex ante recovery, and in the midst of the crisis, the exact dynamics of what the recovery looks like is quite difficult to predict. If that
I hear you. I wonder if we have an economic recovery which is sluggish and slow. So as we unlock, we find out that a lot of firms just can't survive in a social distancing kind of world, et cetera, and so forth. So growth is nowhere near V-shaped. It's best W, it's probably U, whatever. But I wonder if oil prices have a much stronger rebound, not because demand is so strong, but because all of this supply has been curtailed and just can't switch back on.
And I think there's a more nuanced answer to this. So I think two things happen. I think, yes, you lose so much supply in this crisis that actually what is left it's like last man standing is going to do really well.
Right. Yeah.
If you can stay in the game long enough, then you're going to do very well, because bringing back that supply when the demand picks back up is going to be very difficult. So there's going to be a price spike. The other thing I think you're going to see during this crisis is that if you think about there's a big shift in society towards environmentally friendly solutions, the green solution. Now, if you look at the European oil majors, they've focused very much on renewable energy, so wind farms, battery technology, all these things. We spent 100 years fiddling around with battery technology, and we're a bit further advanced than we were, but storing electricity remains a massive problem. Yeah. And one of the major sources of R&D and budgets for that has been government subsidies made from oil tax revenues and things like that. Well, guess what? They're not there. So to me, the technology that we're most comfortable with is carbon capture technology. We're fairly comfortable with carbon science so my guess is that the US, who are focusing much more on, so Exxon and people like that, who focus much more on carbon capture technology rather than renewables, you'll see a shift in, because of its low price point, oil becomes very desirable as an energy input. The environmental impact of oil can be mitigated by much more economic research into carbon capture technology and things like that, which is very much the US focus and has been of the US oil majors, certainly. Right. And therefore, if you can, and carbon science we're much more comfortable with, you can foresee a world where the energy input price is low enough. We don't have these huge subsidies to throw at the alternative renewable energy sources and battery technology, so there's a focus on carbon capture. And therefore, the march is very much back towards oil demand going forward, because we couldn't afford to carry on. So I do think there could be a very interesting story for oil over the next decade, two decades. So whilst, if you'd asked me 2-3 years about electricity and alternatives to oil as an energy source, we would have been talking about renewables and things like that. Actually, I think this low price point might shift the focus on the environmental lobby towards carbon capture technology, and we could see a whole new, because of COVID-19, it might actually lead to an ultimate renaissance in oil as an energy input.
Interesting.
That's very off topic, really.
That's all right. No worries. Let's. I want to get it back because we don't have that much more time. I want to get us back to something we alluded to, which was that great vast silence that is OPEC++. So you and I have been talking for a couple of years now about how OPEC is a really troubled / semi-failed institution recently. I mean, it's, for all of their attempts to cut production in order to prop up the markets, it's really devolved to just Saudi Arabia. Saudi alone can't really manage the market. They tried to pull Russia in, Russia and Saudi together still can't really manage the market, and they don't seem to work terribly well together. There was a point where I recall you and I were speculating on the possibility that the only solution for OPEC survival was for the U.S. to magically become a member, which I think we both discarded as completely politically implausible and unrealistic. And then just a few weeks ago, we had Donald Trump effectively engineer an OPEC output cut. And in a sense, de facto, the U.S. has sort of fallen into a position of being a supporter of the cartel, which is extraordinary. And has had no impact whatsoever. It's been one of the least influential OPEC cuts I've ever seen.
Well, I think you've got to put it in context of this is probably the least foreseeable scenario that OPEC could legislate for. I mean, losing 30 million barrels of demand sort of at the click of a finger because of a virus is difficult. Clearly, there's been some very heavy-handed management of Mohammed bin Salman in the background by Trump, who basically threatened to pull away military support if they
Right.
didn't manage to get their house in order. The OPEC plus cut right now, I mean, it's all, you know, it's shutting the stable door after the whole horse has bolted, unfortunately. You know, you've lost 30 million barrels of demand. OPEC produces, you know, OPEC plus whatever is, you know, even if they all shut down completely, they'd probably only just about manage to curtail the demand destruction.
Yeah, that's about right. So OPEC plus is about 30 million or so. I mean, the US, KSA, and Russia is about 30 million, which is about what we lost in demand in real time.
Yeah. So, and as we all know, I mean, anyone with a basic, you know, who's done basic game theory and microeconomics knows the prisoner's dilemma is that, you know, complying with cuts and how and who takes the, you know, if you try and apportion these things equally, everyone's going to cheat in the end. So OPEC unfortunately has lost its way. You know, one of the major things that they relied on was the US being an energy exporter. Now, of course, the US right now has got major issues with its own internal economics in the country. So, you know, everyone's trying to cut things back. But to me, it feels like OPEC's time is probably done. I mean, ultimately, prices will solve all these problems. And which countries remain and who really wants to help, who lasts the course is going to shape whatever comes afterwards. But ultimately, it's been, once shale oil technology in the US was able to add all the incremental supply that the OPEC plus guys removed, because for every million barrels that OPEC plus removed, in the end, the US shale oil guys would be able to fill the void.
Yeah.
So you needed a sort of, unfortunately, most sort of cartels or, you know, oligopolistic monopolies, or, you know, I'm trying to think of, you know, what OPEC's become really. But, you know, the cartel itself, ultimately, once the market forces are just too great to control in this situation, and it shows the weakness of the cartel when you actually have a significant event. Much like actually when OPEC were cutting supply during the credit crisis in late 2008, early 2009, their cuts really didn't touch the sides of the problem, because OPEC can't act as fast as prices can react. You know, OPEC relies on people getting together in a room. You know, once upon a time, prices changed a few cents every day. For most of the 80s and 90s, they changed. Maybe they had the odd rally on a significant event, or a significant sell-off on a significant event, but they didn't move much. You know, once the financial markets became the de facto pricing mechanism, OPEC were always playing catch up. You know, the tail can't wag the dog once the derivatives market became too big.
Yeah, and you know, OPEC's always struggled with sort of the inherent instability of the equilibrium. I mean, a cartel is an unstable equilibrium. It requires an enforcement mechanism to keep it functional. You know, back at the turn of the century, the Texas Railway Commission had at some point, you know, the benefit of the National Guard. I mean, you actually had Oklahoma guardsmen being called out to enforce closures on curtailed wells. You know, the Saudis have never had that kind of influence, and never will.
No, I mean, effectively, if you look at OPEC, effectively the cuts have only, or the actual political power in OPEC came from KSA basically, and leaning on the other Gulf states through an OPEC. You know, Ecuador and Nigeria and folks like that never really got on board with what they never drank the Kool-Aid in the same way.
It's pumped what they wanted.
Yeah, and you know, and so it was a mechanism that was on borrowed time, and you know, part of it is that, and I suppose what I alluded to without really saying it, and you did as well, is that OPEC's strength came from Saudi Arabia. Saudi Arabia's strength came from the fact that they were de facto
had US military and political support. So, they had this, implicit big brother, or if you want to call it that, that they could bring to bear. And then you saw OPEC when Iran's and Russia started, and Iran, Russia, and Saudi started to have a sort of dance politically around each other, and the US lost interest in supporting Middle Eastern policy in the same overarching way they had done for the preceding century. As they became energy independent, OPEC's time was starting to come to an end, and Russia joining, unfortunately, in a loose affiliation, bought it another 2-3 years of credibility, 2016 to now. But unfortunately, once you got to 2020 and you had this significant event, you lost. OPEC doesn't have the ability to stand in the way of this problem.
Yeah, I think, and curiously, I think, adding the Russian barrels in sort of the OPEC plus also included having to accommodate Russian opinions and preferences in OPEC policy. And so I think what we saw this time around was a lot of frustration between KSA and Russia on what should we or shouldn't do. Should we do, or what should they should or should not do. And you had this really bizarre scenario where the Saudis are, flooding the market with crude as a way of punishing the Russians for not towing the OPEC line at exactly the moment that demand is falling off of a cliff. I mean, the Saudis couldn't have stumbled into a worse scenario.
And I think that's the problem. And I think, I don't know that there's any. The trouble is the credibility. Once the curtain's been lifted and you've seen the emperor's got no clothes, I think, unfortunately, that it was all held together fairly tenuously in the latter stages, and now I don't know how it can ever be credible. And the market will hopefully recover and just be governed by market forces, which actually, in the longer run, is what oil's required. Because we propped up. We tried to support oil prices to support political budgets rather than costs of recovery,
Yeah, we always look at, what is the budget break-even rate in various petrostates in thinking about our oil price forecast. And that always made me sort of scratch my head. I mean, the interesting prices are, what price does it require to motivate investment, or what price does it require to motivate consumption to clear the market? Yeah. What price does it require to balance my budget? Well, I don't. Well,
and it sort of rather suggests that people's budgets increased with increasing oil prices, rather than necessarily, and we saw it. We saw a huge proliferation of sovereign wealth funds in the Middle East, and unfortunately, and the ramifications for that are potentially huge for the wider credit markets. We've already seen it in 2015-16 when oil prices came off, and the sovereign wealth funds suddenly stopped doing their sort of disbursements of and calling in credit lines rather than doing things, and we're going to see that again. What does it mean for Middle Eastern for vision for Mohammed bin Salman's future vision for Saudi? What does it mean for the Qatari sovereign wealth fund? What does it mean for all these things? Because this has
the petrodollar market. I mean, those hundreds of billions of dollars, trillions over time that the petrostates, that the Saudis and the Kuwaitis in particular, were recycling into the U.S. Treasury market. It's sort of it's not sort of an explicit, but maybe an implicit sort of arrangement. We're going to run a massive current account deficit. We're going to import your crude oil, and in exchange, you're going to take those dollars. You're going to buy our treasuries.
Yeah,
I mean, that's the only way that system worked.
Yeah.
And now you've got this system where, well, those that trade deficit has now shifted to other trade partners who, to some
and this is why the pace of recovery and what it looks like is very difficult, because the Western economies are to a certain extent partially reliant on that money for certainly at a government level, but UK real estate, UK US real estate, the art market, there's so many markets that somehow have fared well. Now, don't get me wrong, there's the petrodollar is not the only dollar participating in these, but what happens to the Western economies is going to look very different without this source of ready without access to this money. And so it's going to be a very interesting few years to see if the oil price were to stay at a sustained low level for some time. It's going to be interesting to see its impact on the US. It's going to be very interesting to see what the impact is on the credit markets and on some of the associated markets as well.
Interesting. So it looks like I've got, because one of the reasons why I wanted to revisit our little chat here is because I wanted to have a little bit more of a sense as to what your thoughts were on how the physical market was going to be evolving over the sort of the medium term looking forward. And I think I've sort of pulled kind of three different sort of themes out of our conversation. One is this sort of extreme oscillation that you get in storable commodities markets when supply gets curtailed and then has to and demand recovers, can provoke these big rallies or these big price sell-offs, and then followed by these big rallies and perhaps another sell-off. So I think volatility is here to stay. Is here to stay. It's one of the messages that I'm getting. Another one is that OPEC as a managing system for the crude oil market has probably seen its best days behind it. And you raised some really interesting points about how crude may have sort of another burst of interest as a low cost energy source, given what's been happening with this changing dynamic that we sort of moved down the cost curve, and this makes in sort of a curious way crude a bit more viable over the longer term relative to renewables that would otherwise be competing.
Correct. Yeah. I mean, I think it'll be, and that has huge ramifications for the companies and the oil majors that fare well. Like I said, there is not a schism, but there have definitely been two competing schools of thought in the oil majors. Some have been focusing in on renewable energy sources, and others have been focusing on carbon capture. Equally, there's been a retooling to look more, perhaps, certainly with an Exxon, they've looked much more at domestic US production and tried to divest some of their Nigerian oil assets and things like that, and try to focus really in on the technological play. So how the world looks over the next, I think oil may well have a renaissance. I mean, it's hardly been doing badly as it was, but it was certainly, it became a bit of a pariah. But it's like with many things, times of crisis call for a reassessment of prevailing logic, in the same way that COVID-19 is making us rethink many things at an individual and as a society and a sort of international level. So it may well be that we have a period of slightly straightened economic times globally, and low cost energy becomes a very important factor in that, rather than expensive renewables. These are not the $1 million questions; they're the $1 trillion questions, really, because that's what the future. They are where the future lies. But certainly, in the near term, there's more pain to come. There's more volatility to come. The volatility will manifest itself locally. You'll have more. One of the reasons you've had a bit of you're having a bit of let up in the US is the US have allowed some of the strategic petroleum reserve to be rented by various traders. So they've made available about 25 million barrels of strategic storage to rent to Total have taken some, Exxon have taken some.
Why would the US government do that?
Because they struggled to get in order to, you remember there was Mnuchin and Trump were saying we're going to buy we're going to buy for the strategic petroleum reserve. That would have taken some legislation. It would have taken an act of law to enable them to do it. It wasn't going to happen quickly enough to solve that, to alleviate that immediate problem. Renting space in the SPR, which is available to oil majors and traders, is a very, very quick way to proxy create that SPR buying without doing it. It does it in concept without doing it in
Sure.
legal.
It's a quick way of getting the crude out of Cushing and into.
Yeah, in the same way that many governments in Europe have stated they're going to add to their strategic stocks at the moment. You know, the price is cheap, why not? So, you know, we've had a bit of respite, but again, we're going to have a period of, you know, there are going to be delivery points where you have too few ships to take the oil, and you're going to have, you know, physical markets in distress. But the paper markets is going to remain under some duress. Now, one thing that will be a big factor is that historically in the derivatives market, you have a large number of people rolling passive length, be it pension funds, be it tracking funds, ETFs, etc., etc., etc. There's a large number of funds that always have to sell the prompt months to buy the next months to roll their positions along. One thing you're going to see now, which is going to be very interesting, is as you put so much oil onto the water, you're going to have the inverse roll. So you're going to have a large number of physical traders buying derivatives to roll their positions incrementally along. So you're going to get more volatility in the intermonth structures, because you're going to have more demand. That's more demand for. You're going to have you have the roll period, which is fixed for for most of the passive length, but you're going to have this spread buying demand in the derivatives space, and this is a bit niche and technical, but you're going to get that coming at a time, not necessarily at the same time as the passive length rolls. So you're going to get a lot more intermonth volatility as well. So even structurally, you're going to add a dimensionality of volatility.
Let me see if I understand what you're saying. So I've got access to floating storage. I take some cash, I buy some barrels, I put it into the floating storage, I sell for it as a hedge, I've locked it in, great. My hedge expires. At that point, in order to continue the trade, I then have to buy in the futures market and sell in the futures market, so buy that spread. And so now I'm introducing sort of pressure on the curve, you know, to sort of increase.
Yes, you're adding an extra input of volatility, I suppose.
Right, which is interesting. I hadn't really thought about that, but makes a lot of sense. So I keep coming back to this this idea, and also something else that you said, which really resonated, was you know, with all this storage, you know, with all these tankers, these BLCCs that are sitting there and are booked out of storage, they're not available to actually carry cargoes from point A to point B. I mean, even if demand has dropped from 100 million barrels a day to 70 million barrels a day, or whatever it's hit, you still got 70 million barrels a day that got to move. You can't take up all of our transport.
And that means that the cost of transporting that around might get prohibitively expensive, which means that prices have to reduce to find the end user demand.
And also, you know, you'll also, I think, find, you know, the potential for localized market disruptions, which I think is your sort of bailiwick. You know, sure, I can get you that, you know, that transport for that barrel. I just can't get in the right time or the right place or clean for the right crude. It's a very complicated market once you dig into the details.
Well, to put it in context, last week you could have chartered out a VLCC on a daily rate that if you rented it out for the whole year would have given you enough money to buy it with cash. You know, so you could rent for a year the value of the ship, you know, 2-3 months ago. So that tells you how much demand there is for storage, and B, how much it's going to start costing just to transport this stuff around. And, you know, equally, you know, that getting vessel, once you get a large amount of the tanker fleet on storage somewhere, you're going to end up with all the ships in the wrong, you know, getting this, normally ships end up, they go back, they pick up there and they drop there, and then there's a continual circulation around the globe. There's key routes and they're all going. You know, you're going to get large numbers of those ships stuck, and you're going to create on the water the same problem that you've had in Cushing, where you have too much oil at the load port and too few vessels to take it. So it's going to have to, you know, so you're going to end up with issues there. So, you know, volatility is going to persist. There's going to be some brutal moves. It wouldn't surprise me if we see some quite volatile moves coming into expiry of contracts. You know, people want to see an optimistic solution, but I see, you know, plenty of things to be pessimistic about for the foreseeable.
I do too. And I think almost perversely, I think that as we go, we'll find ourselves in the third, maybe the fourth quarter, with this really bizarre scenario where we have a lackluster, anemic economic recovery, and yet crude oil is spiking because even a modest increase in demand just can't be accommodated with sticky shuttered supply.
Yeah, I mean, one thing to consider is that obviously the demand spikes that occur will be at least initially well catered for by the borrowed demand in storage.
So agreed.
So
that story, but that
makes the recovery ultimately that much more interesting to watch, because that borrowed demand sitting, you know, if you effectively have 1.5 billion barrels of oil on the water, or let's say, for sake of argument, let's say you end up with 1.5 billion, 2 billion barrels of oil all sitting around in storage globally. Well, you know, that's a fairly big oil field over the course of a year's production. You know, that's quite a lot of that demand recovery already taken care of. So that keeps
between 10 and 20 days of global demand.
Yeah. So that's going to keep a lid on the supply side recovery, and that really means that you're going to see more defaults because they're going to be kept at a lower price point for longer. So they're going to be less able to service it. But ultimately there's going to be no investment in new projects right now. There's going to be, you know, and you know what we saw in the last recession in 2008, 2009. One really interesting thing is that a lot of the oil field engineers in the US were a particular vintage, and they all got to a stage where they were about due to retire, and the business got a bit tricky and they all retired. And then suddenly when the shale oil boom came, they were paying massive sums of money just to get people back. So, you know, you can see, there's so many nuances, so many facets to these arguments.
There really are.
And as we've always, as you and I have said it all the time, it's such a highly dimensional problem. There's going to be issues in many of those dimensions for a long time to come. And, you know, it's like they always say, caveat emptor, you know, buyer beware. But, you know, but I could say the same, seller beware. You know, it's an easy market to trade.
Andrew, it's always a pleasure. And
it's been really good fun.
Honestly, I know we could go on for hours and days, and I really do look forward to continuing the conversation. It's really been fascinating and interesting, and thank you very much for taking this time.
And thank you for having me. It's been a pleasure as always.
It has. And also thank you very much to our clients and other viewers. And I would invite you to stay tuned. We have other videos that we will be bringing out in the days and weeks to come, as well in our Beyond Coronavirus series. We'll be looking at emerging market consumers and whether or not they are sort of down for the count. And in our Dolfin Discussions series, we're looking at the yield curve and how on earth you can position yourself on the yield curve in a zero interest rate environment. And those are just a couple of the topics that we're looking at over the course of the next few weeks and months. So lots of interesting discussions for you. If you have any questions, feedbacks, comments, please feel free to reach out directly to me, james.gutman@dolfin.com, or you could also reach out to marketing@dolfin.com or your relationship manager. Thank you very much, and look forward to presenting another Dolfin video to you again in the near future.